In the world of banking, adaptability is key. But have we learned the lessons of the past? In recent years, we have witnessed a series of bank failures, sending shockwaves through the financial world. Unfortunately, the collapse of First Republic Bank, in particular, they were too busy counting their cheap mortgage profits to notice the rising interest rates and demanding customers. And now they're counting their losses. They have failed to adapt to the changing economic landscape. In this video, we will delve into the intricate details surrounding the downfall of First Republic Bank. Also, we will explore the crucial lessons that must be learned to prevent another banking crisis. Stay tuned as we discuss the rise and fall of First Republic Bank and discuss how we can ensure a more stable financial future. First Republic Bank, a shining example of success, or so it seemed. Little did they know that they were on a one-way ticket to financial disaster, all thanks to their inability to adapt to rising interest rates and an unforeseen bank run. They should have taken a leaf out of Darwin's book, Adapt or Die. Silicon Valley Bank and Signature Bank, the March financial martyrs, had similar issues with rising interest rates, but First Republic Bank thought it was special with its cheap mortgage offerings for the rich and famous. Spoiler alert, they weren't. As interest rates soared, so did their problems, and their wealthy clientele suddenly demanded more for their precious deposits. Diversification? Pfft, they tried, but it didn't save them. First Republic Bank faced a few years of pitiful earnings, but it could have limped on if it weren't for the good old-fashioned bank run. This banking fiasco begs the question, should we rethink the rules on liquidity and make stress testing more imaginative? Or just let the banks continue their race to the bottom? Welcome to the digital banking age, where your money can vanish faster than you can say bank run. SVB saw a whopping $40 billion disappear in a single day, but First Republic Bank managed to outdo them with a jaw-dropping $100 billion exodus in the first quarter. Bravo! Clearly, it's time for a change. We need to address the cliff edges for banks crossing asset size thresholds and maybe even undo some of that 2018 bipartisan banking legislation. Let's apply higher standards to mid-sized banks, shall we? It might just prevent them from joining the ranks of the fallen. Last week, Michael Barr from the Federal Reserve pointed the finger at Trump-era deregulation and incompetent supervisors. But maybe we should also look at the ways banks move from one regulatory regime to another. Increased scrutiny for banks nearing thresholds is a good place to start. Enter JP Morgan, the financial Grim Reaper, swooping in to acquire First Republic Bank's assets and deposits. Sure, it limited the cost to the FDIC, but it raised concerns about consolidation and the too-big-to-fail problem. JP Morgan's now the star of the two largest bank collapses in US history, not exactly a title to be proud of. Allowing JP Morgan to make the acquisition may be detrimental to competition, and it certainly doesn't help the too-big-to-fail narrative. Perhaps it's time to ensure smaller and mid-sized banks are managed and regulated effectively, and not likely to fail in the first place. First Republic Bank isn't the only one biting the dust. FTX, SVB, Deutsche Bank, and Credit Suisse all face the bankruptcy monster, with some getting rescued by other banks. These depressing events emphasize the need for reform in the banking sector before more dominoes fall. The 2023 banking crisis has claimed its fair share of victims, and First Republic Bank stands as the largest US casualty to date. JP Morgan Chase's acquisition may have limited the FDIC's costs, but the collapse of a seemingly successful bank sends a chilling message to the rest of the financial world. It's time for international regulatory bodies to join forces and implement uniform stress testing and liquidity requirements. Let's create a more resilient financial ecosystem so we can avoid the embarrassment of more bank collapses and consolidation. After all, nobody wants to be the next First Republic Bank. Banks must also step up their game with contingency plans to handle any unforeseen disasters. Clear communication with customers, swift responses to market fluctuations, and maintaining adequate capital buffers to absorb losses. These aren't just nice-to-haves, they're essentials in this cutthroat financial landscape. The banking crisis and the collapse of the First Republic Bank reminds us of the need for reforms, effective management, and regulation in the banking sector. Keep your eyes peeled for the dangers lurking in the shadows, where risks and instability threaten to swallow even the seemingly successful institutions. Proceed with caution in this dark financial world, because you never know which bank will crumble next. Remember, it's not about heroes in the financial world, it's about numbers on a piece of paper and the art of a good deal. A thriving financial system relies on deals, while a dying one gasps for air. The fact that JP Chase was able to buy the troubled First Republic Bank indicates some stability. Or maybe it's just another predator feasting on the weak. During the 2007-2009 global financial crisis, uncertainty and fear hindered deal-making. SVB didn't find a deal in March either. When asked why he didn't bid for SVB, a bank executive sarcastically mentioned its $20 billion balance sheet hole. Ouch. JP Morgan's deal for First Republic included three parts: $10.6 billion in cash to the FDIC, a promise to pay $50 billion more, plus fixed-rate interest over the next 5 years, and a credit guarantee for assumed loans. Designed to maximize JP Morgan's payout and minimize the FDIC's return, it's a deal that reeks of desperation. Though the guarantee and loan may seem odd, they serve a purpose, easing JP Morgan's regulatory capital requirements and managing its liquidity consumption. Clever, but it doesn't change the fact that First Republic Bank's collapse has left investors and other banks shaking in their boots. Share and bond prices of smaller regional banks have plunged, and if this spooks depositors, more deals and possibly more collapses will follow. The JP Morgan and First Republic Bank deal highlights the importance of good deals in the financial system and the need for banks to manage liquidity consumption. As the banking crisis unfolds, investors and depositors must remain vigilant and observant of the financial landscape. The fate of smaller regional banks hangs in the balance, and the consequences of this deal will likely shape the future of America's banking sector. It's crucial for regulators to closely monitor the situation and adapt policies to ensure the stability and resilience of the banking system. Otherwise, we might find ourselves watching the sequel to the 2008 financial crisis, and no one wants to see that. So, as we navigate this treacherous financial landscape, let's take a moment to reflect on the collapse of First Republic Bank and its implications. One thing's for sure, no one's immune to the dark humor and twisted irony of the banking world. After all, who could have predicted that a seemingly successful bank could crash and burn in such a spectacular fashion? In a world where adaptability is crucial, it's time for banks to ditch their old habits and embrace change. After all, counting cheap mortgage profits while ignoring rising interest rates and demanding customers is a recipe for disaster. Banks must learn to identify sudden risks, improve stress testing, and implement more stringent liquidity requirements, or face the consequences. As we've seen with the downfall of First Republic Bank, the current banking system is a ticking time bomb, with risks and instability waiting to strike at any moment. The only way to prevent a full-blown financial meltdown is through collaboration between international regulatory bodies and the implementation of uniform stress testing and liquidity requirements. But let's not forget the role of banks themselves. They must develop robust contingency plans to manage crises, communicate clearly with customers, respond swiftly to market fluctuations, and maintain adequate capital buffers to absorb losses. In short, banks need to clean up their act and start taking their responsibilities seriously. In the end, the banking crisis and the collapse of First Republic Bank serve as a stark reminder of the need for reforms, effective management, and regulation in the banking sector. With more banks teetering on the edge of collapse, it's essential that we remain vigilant and tread carefully. If we don't take action now, we might just find ourselves reliving the horrors of the 2008 financial crisis, or worse, starring in the sequel. And trust me, that's a movie no one wants to see. So, if you like this video, leave a like, comment, and share this video to save the world from another banking crisis. Subscribe for more.